afternoon all, and thank you so much for joining our webinar today on taxation in Oman, especially with the recent updates that took place. We are joined today by Thomas Van He from Aurifer Middle East Tax, and my name is Marley. I'm from LexisNexis Middle East. Before we get started, firstly, I'd just like to thank Thomas for taking the time to update us on key developments in Oman. Secondly, if you have any questions throughout the webinar that you'd like to ask Thomas, or if you experience any connection issues, please do not hesitate to submit a question or just a query in the chat box to the right-hand side of your screen, and we will try and get back to you as soon as possible. So Thomas will do the presentation, and then we will follow that with a Q&A session. So please do get your questions ready for that session. And that is pretty much it from my side. I will now hand over to Thomas to start the session.
Thanks a lot, Marley. Can you hear me well, Marley?
Yes, can hear you well.
Okay, perfect. Then I'm going to assume that for everyone attending the webinar, it's the same thing. So welcome also on my behalf, and thank you to LexisNexis for hosting us on very interesting developments in the Sultanate of Oman. As you might have seen as well, 2 days back, the executive regulations finally came out, and we're less than a month away from the actual introduction of VAT in Oman. The introduction of VAT in Oman being one of the most remarkable and eye-catching developments in the Sultanate in the last few years, with the aim of achieving a fiscal balance. Oman is one of the countries which is economically the most hit by the current pandemic, and also historically has been, as with the other GCC states, relatively reliant on income from the sale of oil and gas. Today I'll be taking you through the Omani VAT law and the Omani executive regulations where appropriate. We will try to finish within the hours. So it's currently 5:05. We will try and finish around 5:50, and at 5:50, as Marley said, we'll be taking questions to then try and finish around 6. For those of you who want to have another look at the webinar, I think Marley will be happy to send the slides across, and we will also be putting the recording on our YouTube channel. So feel free to click and subscribe. We will put a link to the recording as well on our LinkedIn page, and I'm sure that LexisNexis will do the exact same thing. You'll find also on the LexisNexis database the latest law and executive regulations, as well as some commentary as well on our end on the introduction of VAT in Oman, and some commentary around the law. Without further ado, this is our agenda for today. We'll be looking a bit at how this development is part of a broader development in the GCC, where we are currently, and what the legislation tells us. And we will also try and give some tips and tricks around how to prepare and what to do next in essentially the next 4 weeks. So having a look at the implementation of that in the region, the GCC countries are one of the last countries to introduce a VAT system, a value-added tax system, which has its origins in Europe. There's notably still 2 countries around the world that do not have, 2 important big countries around the world that do not have a VAT system, which are Brazil and the US. And Brazil is going to adopt one soon. The US, it's not going to happen just yet. But so the idea was between the GCC states to sign a treaty, and for all of the 6 GCC countries within a span of around 2 years to introduce VAT. So that has not fully happened, as we will see in a second. But so all 6 GCC member states, they should be aligned in terms of the application of the VAT law. Now, what has happened is, as you see in front of you, the UAE and KSA were the first ones. Yours truly was one of the authors of the KSA VAT law. So KSA and UAE implemented VAT with effect of 1st of January 2018. Bahrain followed on the 1st of January 2019. Now we've got the next state, so Oman, in introducing or implementing VAT as from the 16th of April of this year. Kuwait and Qatar, where there's still a bit of question marks around the implementation. Qatar has systems ready, has the law ready, needs to press a button, and that will happen sometime soon. Kuwait is a bit more difficult since it has some, it has a parliament as well to vote on the law. Just bear with me for 1 second. I'm going to try and do something technical here, which will hopefully allow me to see my better state. So if you see some things flashing, Marley, I don't know if you can see, I think you can see the wrong screen. You can see 2 screens in front of you, yes. 2 little screens instead of 1 big one.
Yes, yeah, indeed.
Okay. So that one is not going to work. So let's just go back to the other status, this one, which is a bit easier on the eye. So what's the status right now in Oman? Where are we? So it was introduced, as I said in the introduction, amongst others because of the financial constraints of the COVID-19 outbreak. You must know that it has put a strain on the budgets of the ministries of health. And obviously also tourism in Oman has taken a big hit. That's amongst others also due to the fact that it's currently not easy to travel into Oman. The introduction of VAT will obviously also bring in quite some money. So depending on the estimates, it will bring in into the budget of the state either around 1% or 1.5 to 3%. So 1% of GDP or 1.5 to 3% of non-oil GDP. That's very important to balance the budgets. And even though in 2019 the tax revenues were already up around 8% compared to the budgets, amongst others due to the widening of the scope of excise tax, we expect a further positive impact in 2020. Important also is that when Oman budgets its revenue on the state level, it uses an average oil price. So the for financial year 2020, the forecast for the oil price was $58 a barrel. We're currently, and I looked it up this morning, at around 68. That would be good for the budget. However, the IMF, when it makes its calculations and it looks at expenditure of the state, all things equal, it says that Oman needs a price of $87 per barrel in order to balance its expenditures with its income. So that's obviously quite a high oil price and is, under the current circumstances, not feasible in the short run, and that has also accelerated the implementation of VAT in Oman. And then we were finally there on 12th of October. The law was issued. It was only published a few days later, on the 18th of October 2020. It announced a 6-month implementation window, or 180 days. So we're nearly there. 16th of April or within less than a month, VAT will be applicable on the sales of goods and services in the Sultanate of Oman. Only now, recently, the executive regulations have been published 2 days ago. However, the VAT registration was already possible for the largest companies, and we will get back in a second to the stagger or to the phases in the registration. The first phase has already finished, and there's also been quite some guidance already published as well by the Omani Tax Authority. Omani Tax Authority, which went through a reform where before it was called the General Secretariat of Taxation, it is now called the Omani Tax Authority, has new leadership, a new title, and some new bells and whistles. Now, for those of you familiar with the GCC VAT framework, you'll see that the Omani VAT law is close to the GCC VAT framework. And for those of you who, as myself, share a European background, you'll see, if you analyze the GCC VAT framework, that it's derived from the EU VAT directive in its 2010 version. Now, if you look at the structure of the Omani VAT law, it is close to the UAE VAT law in terms of its structure, and it has a very similar to the other laws which have been published so far for the other 3 countries. Similarly, a same rate, 5% with exemptions, 0 rates, and out-of-scope supplies. Small caveat, obviously, most of you will know that Saudi has tripled its VAT rate last year on the 1st of July and is now requiring the application of a VAT rate of 15%. When you look at the law is a skinny law. There's a lot of details in the regulations, and I'll admit that I'm still working my way through them fully. There's a lot of detail. It's currently also only available in Arabic, unfortunately, but there's a great deal of detail in there. Important also is, like in Saudi, the regulations are issued by the tax authority, not by the cabinet. That means that if the tax authority considers that certain provisions are insufficient, don't fully serve their purpose, subject to amendment, require maybe different wording, then they have the power to do so in quite an easy way. So I would say that means that, similar to Saudi, we'll probably see multiple amendments of the regulations as well. In the Omani VAT law, we see broadly the same rules as in the GCC VAT framework, and it has the same structure as most VAT laws would have around the world. Scope of tax, place of supply rules. We'll get back to some of these elements in a bit. Taxable value, tax liability, date of supply, and imports and import exemptions. In its interactions with the other GCC countries, for those of you who've been around for a bit longer in the region, you will have seen that the GCC VAT framework suggests that there will be an IT system in place to map all transactions between the GCC countries. A bit similar, trying to mirror what is being done for customs purposes. However, Oman as well recognizes that the system is not in place right now, and for now will not apply any of the principles of the GCC VAT, let's say, matching provisions from the treaty. That means that Oman, vis-a-vis UAE, Bahrain, and KSA, it will consider them as third countries, and vice versa, they will do the exact same thing. So this means that irrespective of whether goods come from GCC countries or services are received from GCC countries or from non-GCC countries, it doesn't make any difference at all. So we are dealing from Oman with third countries in the exact same way as we are with non-GCC countries. That means that if services are received by a Omani business from abroad, that they will be subject to a reverse charge, and that VAT will also apply on the import of goods. Vice versa, you'll be exporting goods from Oman to GCC countries or other countries, and you'll be providing services from Oman to abroad, which will not be subject to VAT. The thresholds applied in the Omani VAT law are derived from the GCC VAT treaty. So 100,000 for the mandatory threshold, 50,000 for the voluntary one. Again, I'll get back to the phasing in a second. These thresholds mean that if you are making supplies, so your turnover, if that is in excess of $100,000 on an annual basis, whether in the last 12 months or in the next 12 months, you have to register as an Omani business for VAT purposes. If it is below 100,000 and above 50, you can consider registering for VAT purposes. So I said there's two tests. There's a forward-looking test and there's a backward-looking test. And you need to apply that test based on the turnover that you had in October of last year. And when I was mentioning that we need to take into account turnover, that's only part of the story. Also, any services which you receive from abroad for which you as a customer are liable for the payment of VAT need to be counted. And also, and this is a bit of a reminiscence of the GCC system, inter-GCC supplies also need to be counted towards the registration. Now in front of you, you see the different phases and staggers. When I mentioned the voluntary registration, that's already applicable as from now. The first category that needs to register for VAT purposes is the businesses with a turnover in excess of 1 million Omani riyals. So those will be the ones who are compulsory already under the first wave, let's say, and for which VAT will apply as from the 16th of April. Subsequently, you see staggers going down. You'll remember that Saudi also had staggers, one stagger, and Bahrain had multiple staggers. The UAE did not, but what the UAE had was a phased first VAT return to be filed. And so you see that essentially the smallest businesses, the ones with the turnover below 249 or 259,000, sorry, 250,000 Omani riyals, that they do not have to register before February 28 of 2022. So they have another year. They can register already, but they don't have to right now. So this is supposed to ease the burden a bit on the smaller companies. What other types of special registrations are there? Similar to the other three countries so far, there is VAT grouping as well available for businesses with multiple legal entities. They can apply to form a VAT group. Now, for non-resident persons, think of the iTunes, Spotify's, Apples, and so on of this world. When they are conducting business in Oman for the purposes of private persons, then they need to register for VAT purposes in Oman as from the first riyal that they make. That registration can be done directly or through a tax representative, but a responsible person needs to be appointed. Once you get registered, you get a number, and here's a bit the first surprise compared to the other GCC states. We don't have 15 numbers. We have a very European style tax registration number. 2 letters and 9 numbers. So every number, VAT number in the Sultanate of Oman will start with OM, and then you have 9 letters. Similar also to other countries, pre-registration input tax can be deducted upon registration, and there's also an exemption for businesses making exclusively zero-rated supplies. Upon registration, you'll get a VAT registration certificate, and let's say a bit in an old school manner, a rule which was copied from Saudi, which we don't have in the UAE, but for some reason, some businesses like to also display their VAT registration certificate. That certificate needs to be displayed in every place where an activity is conducted. So whether you are a consulting office or a store or a restaurant, you need to display that VAT registration certificate. Again, old school methods for new world problems. Regardless of the number of branches and activities that a legal entity has, there will only be one VAT number, and that VAT number needs to be included in all tax invoices it raises, but also in communication with the tax authority, and so on. So commercial documentation needs to include the VAT numbers. Now, what did we see in terms of the policy adopted by Oman? Interestingly, when we go back to the treaty, you see in front of you in the left column some must zero rates. In the right column, some must exempts. And in the middle column, there's a bit of leeway between every state to adopt certain positions. And Oman has taken a bit of a unique stance in that. Not so much necessarily in respect of the zero-rated food items, because Bahrain has that as well. Saudi and UAE do not have any zero-rated food items. So you see a list of those food items in front of you. There's around 94 or 95 items which are categorized. Those are staple goods or goods which are consumed by the wider public. This will help somewhat in reducing the impact of the introduction of VAT on the cost of living, given the fact that these are goods which are often consumed by a lot of people. Together with the exemption for real estate rent, means that you cannot go to your employer and go with reason go and ask for a 5% increase in your salary. Unfortunately, it's not a one-to-one. What is going to be interesting is the interplay between the zero-rated food items and the standard-rated food items. You must know in other jurisdictions, we often have discussions around the Ferrero Kinder Egg, whether that constitutes a toy or chocolate, subject to zero rate or to a reduced rate. There's the example also of the Jaffa cakes in the UK. There's the example of the Subway bread as well in Ireland. So any situations where the zero-rated food items are combined with other items that might lead to discussions on whether the whole good is subject to 5% or 0, or perhaps should be mixed. So that's a discussion that we can anticipate together, obviously, with potential mistakes made in the application of the zero rate. Specifically to Oman, you see on the left-hand side the top two which relate to healthcare and education. So no GCC state so far has exempted healthcare and education. Oman is the first state to do so. It's not entirely surprising, this position. I would say it's rather the position in the other GCC states, which is surprising on a global level, because healthcare and education are traditionally exempted sectors and not zero rated or not taxed. What this means is Oman is going to have the economy which has the most exceptions to the normal rules because of the fact that it exempts healthcare and education. Healthcare institutions, educational institutions providing these services, they will be making exempt supplies. And because of the fact that you cannot apply this simply across the board on the basis of your capacity as an educational institute, you'll often end up being in a mixed position. Give you a simple example. A hospital that has a cafeteria accessible to people visiting patients in the hospital. That cafeteria cannot benefit from the exemption, whereas the food given in the rooms to the patients can. So that's going to be a very interesting discussion going forward. Similar to the other countries, though, in terms of bare land, local passenger transport, and the renting or resale of residential property, Oman has exempt those. What interesting zero rating provisions do we have? We mentioned already, and I'm on the right-hand side now of the table, food items, but also interestingly, as with the UAE, crude oil, oil derivatives, and natural gas is subject to a zero rate. Sea, air, and land means of transportation used for international transport of goods and passengers is also zero rated, and rescue aircrafts and boats are also zero rated. That's pretty much in line with the other states. So the big scoops here are really healthcare and education, food items, and to a certain extent, oil and gas. There's a number of other exemptions as well. For example, for food, if the domestic sale is zero rated, then the import is exempt. Goods and services used by diplomats or consulates, those are also exempt. Goods imported for the armed and security forces, equally so. Expats moving to Oman for the first time, they also have their household items exempt. Non-profit associations, their necessities are also exempt, and so-called returning goods, which leave Oman and then come back, those are subject to an exemption. What zero rates do we have in addition to the ones that we mentioned? So the ones that we mentioned are domestic zero rates. Here we're talking about the goods and services which are subject to a zero rate because of the fact that they are part of an international transaction. Export of the goods from Oman to abroad, those are subject to a zero rate. Goods which are supplied under the customs duty suspension are zero rated, as well as services associated with those goods which are under a suspension status. The re-export of goods, so let's say that you have imported goods for repair and furbishing, and then you re-export them, that's zero rated as well. And importantly as well, is services provided to customers established outside of Oman. So we don't have the classic zero rating of export of services, which is not really, which is not a concept in the treaty, but which has become a bit of a concept in the other GCC states so far. But services rendered from Oman to abroad, which are not subject to the special place of supply rules, those are not subject to VAT in Oman, and they are equivalent to a zero-rated service. As a reminder, we always say here internally that exemptions are thumbs down, they are bad, and zero rates, they are thumbs up, they are good. The reason for that being that both with exemptions and zero rates, you do not apply 5% VAT on the output. However, for zero rates, you can still deduct your input VAT, whereas for exemptions, the input VAT is not deductible. For out of scope, there's two types of out of scopes. There's material outside of scopes, so therefore income which simply doesn't qualify for VAT purposes. And then there is place of supply out of scope items, which are sales of goods and services which would be subject to VAT in the Sultanate of Oman, but because they take place abroad are not, but still grant right to recover input VAT. A number of practical elements as well, which are important, is in regards to import VAT. Contrary to, for example, UAE, any goods which will be imported, VAT will have to be paid to customs. There's not going to be an automatic deferral to the VAT return as we have in the UAE and as we now have in a number of circumstances as well in Saudi. All of the retail shops are going to have to be displaying prices VAT inclusive as from the 16th of April. Don't underestimate that task for a lot of retail businesses. This is quite a big task. And in terms of record keeping, the tax-related documents, they need to be kept for 5 to 15 years in cases of real estate. Now, the good thing is, expressly in the law and in the regulations, it says that the records, but also the invoices, can be kept in English, and they can also be shared with the authority in English. Potentially, simply there is a translation required if the authority asks the taxpayer to translate the documents. In terms of the filing of VAT returns, this needs to be done end of the month by the 30th, after every quarter. If you, as a taxpayer, you don't file your return, the tax authority has the right to estimate your tax due. So again, this is something which is common for direct tax in a number of jurisdictions, not so much for indirect tax. So let's see how that evolves. The statute of limitations is 5 years and 10 in case of non-registration. So that means that during 5 years, your books, transactions, and income, they can be open to audit. The format of the VAT return is not yet known. We can expect something hopefully fairly standard with outputs and inputs, and then reporting the balance. I'm putting here, hopefully it won't be a KSA style return, because the KSA VAT return doesn't really conceptually make a lot of sense. So hopefully Oman will have learned from this. A very important aspect of the application of the law is designated zones. I don't know yet which specific term that Oman will use in English for this, because in Arabic it has a different term. But so Oman has around 5 specific or special zones, and similar to the regime applicable in the UAE, but now also with the very first free zone established in Saudi, we will have also a special regime there. The VAT treatment of the supplies of goods or services is subject to the same treatment as the one prescribed for goods which have been suspended, or services which relate to those goods which are being suspended. That's what was originally in the law. Now, in the regulations, we see that the free zones or the special economic zones, they need to apply to become a designated zone, similar to the UAE. And importantly as well, the zero-rated status, or if you want, exempt with the right to recover input VAT of the supplies within those designated zones depends, amongst others, on the authorities being able to monitor the goods inside the zone, but also depends on the supplier and the customers being registered for VAT purposes. That holds true for both goods and services, and both to be duly licensed within the zone. So those are a few specifics, which is really just unique to Oman. Now, a tax invoice is a very important element, and even after more than 3 years in UAE and KSA, unfortunately, with a great deal of our clients, we go in to do a type of a health check, and during that health check, we see simply that there's a number of issues with the tax invoice. Why is that tax invoice, or those formal requirements so important? It is because the issuance of a non-compliant invoice is subject to a penalty, but also if you receive a non-compliant invoice, then VAT on that invoice is not deductible. Hence the extremely important aspects of getting it right for these invoices. So in all circumstances where a taxable supply is made, a tax invoice must be issued. There are a number of circumstances you can issue a simplified tax invoice for lower lower values of supplies. In regards to using other currencies, it's not an issue, but for the conversion, you cannot use your systems rate, contractual rate, or a third-party rate. You always need to use the exchange rate published by the Omani central bank. So those are very important things, because again, a lot of mistakes are made there. This is the list of items which need to be included in the tax invoice. You'll see that those are fairly similar to the other countries. However, for example, on the quantity of the goods supplied, it's a bit less strict, and there's less rules on the conversion as such. So where the other states, for example, say that the conversion needs to be displayed and the value needs to be displayed in local currency, here we don't have those rules. We would recommend, nonetheless, to apply them as well. So very important that your invoices comply with this. Again, they can be issued in English, and Arabic needs to be given upon request by the tax authority. Now, what can you deduct? The prohibited goods which are prohibited in Oman, VAT on that cannot be recovered. For mixed taxpayers, we'll defer that to a bit later. There's also three categories of goods and services which are not available for input tax deduction. Goods or services used recreationally, motor vehicles, but also catering services for food and beverages. Contrary to UAE and in line with KSA, a lenient system to deduct input VAT, you can do it at any given time during 3 years. This slide talks about the partial exemption. I will not dwell much on it. It gives you the mechanism for entities which are making and taxable supplies and exempt supplies. So think of my hospital example from before. Those need to apportion their input VAT deduction. So the general rule is the application of a pro rata on the inputs, and there are alternative methods, so-called real use methods, which are foreseen as well in the law. Every year there needs to be done, there needs to be a wash up, a recalculation of that proportion, and then a correction to be made. I'm trying to finish everything on time. There's provisions also in the executive regulations around bad debts. The conditions for bad debts, which imply that you can get VAT back from the Oman Tax Authority in cases where you've already paid but your client hasn't paid you yet. So the conditions there is obviously that you've prior paid to the tax authority, that the supplies that you make, they relate to your taxable activity, that you've paid to the Oman Tax Authority, but that it's been 12 months since you were expecting your payment. Now, the additional condition is that you have written off your bad debt and that you've notified your customer as well that you have written off the bad debt. Again, this is a condition which is also there in UAE. I'm not a great fan of this condition because when you're going to write to your customers that you've written off a receivable, then the chances that you will actually get paid for that are very low. An additional condition is that the supply is not made to a related person. Similar to the other countries, there are special refund schemes. We mentioned already exemptions for the imports by diplomats and the people working in the embassies and the consulates. But you will see refunds as well for visitors and tourists, a bit like the Planet scheme that we have in UAE and in Bahrain. There'll be a refund scheme as well available for taxable persons established in other GCC countries or even outside who can apply for a refund. So think, for example, of the very restrictive manner in which distribution services are treated in KSA and in UAE. In Oman, it doesn't look as strict, but so a similar mechanism is foreseen to ask for that refund. A few words on the transitional provisions as well. You might be tempted right now as a business to issue a few invoices or to receive some payments in regards to supplies of goods and services which will effectively be made after the entry into force on the 16th of April or after the date of registration. Now, the Omani VAT law and executive regulations require you to nonetheless pay VAT to the tax authority in case that the supply of the good and the service is effectively made after the effective date of the law or after the date of registration. An important element as well for the lawyers amongst us is if a contract is silent with respect to VAT, it will be considered as inclusive of VAT, which essentially means that you lose 5% on your top line revenue. So it's a very easy thing to do as such, replace the provisions, but of course it's a big it's a lot of work to be done potentially with all of your customers. We recommend obviously nonetheless to proceed with it because it is highly important to do so. In regards to VAT on contracts which relate to continuous supplies, for example, think of, for example, electricity, water, your television providers. You'll have portions of services which relate to situations before the 16th of April and after. The proportion of after the 16th of April or after registration will be subject to VAT. So you can expect an additional VAT charge there, unless, of course, your provider is happy to forego it and take the financial hit themselves. Now, a very important concept in Oman is the so-called responsible person or the responsible officer. It's an owner, a manager, or a partner of a company. Those people, they face fines and or imprisonment if they don't comply with the obligations under the tax law, and they can also not leave Oman for more than 90 days. That's a very important concept. It's a very, in my view, risky concept because there's humans fill out these VAT returns and humans make mistakes. Machines do as well because the machines are programmed by humans. So this is quite a risky thing. This is really a key person to identify when you register, and it is important also that that person is aware of his or her obligations and rights as well. So for example, you see on this slide some offenses punishable by imprisonment. If you intentionally don't register for VAT purposes, that gives you imprisonment. So that's quite a low threshold to meet. There could be a number of cases in which perhaps there's a bit of a gray zone and you wouldn't necessarily know. I've mentioned here a number of the penalties which are applicable. I'll leave them there for your benefit and to have a look at maybe in a later stage. I don't want to necessarily go over all of them because they are quite a bit. You can see that the fines are relatively in line with the other states so far. However, in terms of the late payment penalties, the Sultanate has taken a much more relaxed approach, applying a 1% per month late payment penalty. So that's relatively low when you compare that to the other states. For example, in the UAE, the late payment penalties, they can go up to 306% in less than a year. So here in 1 year, we would only be up to 12%. In the regulations, there's also the procedure for objection. And interestingly enough, in Oman as well, there's a reconciliation procedure which you can for which you can discuss with the chairman of the Oman Tax Authority and try and reach a compromise or a settlement with the chairman. If you do get into litigation, and I hope you will not do so, then you see the procedure in front of you for the tax disputes. We only have 1 hour, so I don't want to necessarily dwell too much on this one. Quickly, simply for the purposes of what is next, you now are in the phase of preparation. We're in the last phase of preparation. It is really very crucial that in the next few weeks, you as a business, you identify your to-do list and you implement it. Because as from the 16th of April, if you're a business with a turnover in excess of 1 billion riyals, all of your supplies will be subject to VAT. So I've given you a few pointers in terms of what you need to be doing and what you were supposed to be doing already since around July last year for the major companies. And hopefully this gives you a bit of an idea on what to do now in the next few weeks. I'll maybe, in the interest of time, open the floor to questions. I don't know if Marley, you can maybe open the questions bit.
Yes, of course. So as I mentioned to everyone at the beginning, if you have any questions, please submit them via the chat box, and I'll give you an opportunity to do so now. We did receive one question just asking if we'll share the slides. Yes, of course, we will share the slides. We will also make the recording available as soon as possible. So keep an eye out on our social media and of course Aurifer's social media for that. Other than that, very, very interesting presentation, Thomas. I must say myself, although I'm not a tax expert, I did find this very interesting, and will definitely read up on your example about the Kinder egg. So that's quite fascinating. So I'm just going to give everyone a couple of minutes to submit any questions they may have. Otherwise, I think we will end the session there. But Thomas, again, just want to thank you for an informative session. We've got a question here. Okay, so the question is, what about the refunds on services? For example, if I sell a service like beauty sessions and the customer asks for a refund, shall I refund the VAT value?
Yeah, that's a very good question by Ala. Indeed, if you're providing services like, let's say, a mani-pedi, and you're charging maybe not 200 rials, but let's say 20 rials for a very nice salon, and you've agreed with your customer that you will refund, for example, 10 rial, of that 10 rial will be inclusive of VAT. So you'll also be refunding essentially the VAT, which is inside that amount. That essentially means that for a refund, you will issue a credit note, and in that credit note, you will have to show VAT as well in there.
Okay, we just got another question, Thomas. So I don't know if you want to read it out, or if you don't mind if I quickly read it.
Sure, yeah, no. So the question is by Lydia. She's asking whether the cost of living will indeed rise by around 1 to 2%. It's a good estimate. Obviously from a government perspective, it's not something that they like to share, but it's indeed correct that the cost of living will increase. What you usually see right before the introduction of VAT is you see a rise in consumption right before the effective date. So everyone is going to want to buy a new car, a nice handbag, the new iPhone still, while it's still not subject to 5%. Then you usually see a little bit of a slump right after the introduction of VAT. And then it gets absorbed, and people get used to it. It is true that in the long run, it does increase the cost of living, and a lot of states then compensate by giving subsidies or other forms of compensation schemes. I'll take another one maybe, Marley, from Sarim, yeah, or Jamil. Okay. Will the supply be zero rated if the service recipient is based in a free zone? So the regulations specify that in regards to designated zones, so free zones which qualify as one of the special zones, that services are subject to a zero rate, provided that they are provided between entities established in the free zone, and that both entities are registered for VAT purposes. So if you're supplying the service from the mainland to those free zone companies, then it will not be zero rated. Sole proprietors, from the question from Prem, yes, they are subject to VAT. So licensing actually doesn't matter for VAT purposes, because we have a substance over form approach. And this is very important because in the 3 countries so far, a lot of, let's say, owners of commercial buildings, for example, consider that they are not subject to VAT, and therefore didn't have to register. When they finally found out, and they registered much later, they were subject to very hefty penalties. So sole proprietors, very definitely subject to VAT. You're welcome, Lydia and Prem. We've got a few minutes still, Marlene.
Yeah, we do have a couple of minutes. So if you have any questions, now's the time to ask. Otherwise, you can, of course, get in touch with me and I'll put you in touch with Thomas, or you can email Thomas directly. We did get another question, Thomas, so if you quickly want to answer that one.
Responsible. Cumulative in a calendar year. Oof. I believe so, but I would have to get back to you on that one. I do not know that one by heart. I'd have to do a bit of research, unfortunately. So sorry, I don't have a ready-made answer to that one. Oh, not a question, but a great session and very informative. Thank you very much. Since VAT is being implemented in a staggered manner, there will be few suppliers not charging VAT. So the VAT registered vendors and unregistered vendors until October 2021. Even until February 2022, there will be unregistered vendors. So the unregistered vendors cannot charge you VAT. If they do, they are committing a very serious offense. The ones who are registered, they have the obligation to charge VAT on supplies of goods and services made in Oman. But it's a very good question, Andrew.
We're still getting some in, Thomas, so not sure if you can see them.
Ah, yes. Are all government fees exempted from VAT? It's a very, very, very good question. In principle, any supplies made by a government in their sovereign capacity, so the things that only a government can do, such as issuance of a driving license or of an ID, those should be outside of the scope of VAT. It could be a little admin fee, maybe subject to VAT, but for all supplies that only a government can make, those are outside of the scope of VAT. In terms of, do you need to check if a vendor's tax position is correct or not? Yes, you do have to do that. So a quick tip is simply to verify their VAT number with the Oman Tax Authority, to ask for their VAT registration certificate. If they do not have one, then they cannot be charging you VAT. If they do charge you VAT, even if you're acting in good faith and you've paid the full amount, that VAT will not be deductible for you and will therefore constitute a cost as well. So that's a very important aspect of how to deal with your vendors and to make them compliant.
Okay, well, it seems we've reached 6 p.m. And it doesn't look like we have any other questions coming in. So Thomas, I really want to thank you for delivering this very insightful session. I'm sure everyone enjoyed watching you too. So we will, again, like I said, share the slides, share the recording. So have a look out on our social media. We'll, of course, email the link to you as well. And that's it for today. So thank you very much. And of course, thanks to Aurifer for presenting. Have a good evening all. Bye.